If you are waiting for a signal that the financial system is breaking, stop looking at the stock market. Stop looking at the VIX. Look at your email inbox. Yesterday, silver smashed through a record all-time high of $89. It is a historic breakout, the moonshot we have been waiting for. But at the exact moment the price went vertical, the United States Mint sent this to their top distributors. Read the fine print. Rapidly rising silver prices may result in silver numismatic products being temporarily removed from sale. They call it a pricing adjustment. I call it a liquidity freeze. I call it a soft default. Because what is the value of an asset that hits $89 on a screen if the sovereign mint of the world's reserve currency refuses to sell it to you? This isn't a logistics error. This is panic. The U.S. Mint operates on thin margins. When the price of physical silver moves faster than the bureaucrats can update their spreadsheets, they have two choices: lose millions of dollars selling to you at yesterday's price, or lock the doors. They chose to lock the doors. And here is why they are panicking. While New York traders are celebrating $89 silver, the Shanghai Gold Exchange just clocked a price of nearly 22,400 yuan per kilo. Do the math with me. That is $100 per ounce. Right now, as we speak, there's an $11 arbitrage gap between the West and the East. That is a 12% premium just for moving metal across the ocean. This is an economic vacuum. It is sucking every available ounce of physical silver out of London and New York and shipping it straight to China. The U.S. Mint knows this. They know their inventory is being raided, so they pulled the buy button. While the physical window is slamming shut, the paper window is being thrown wide open. The CME Group, the people who run the COMEX casino, just announced they are launching micro 100-ounce silver contracts. Think about the timing. Physical metal is disappearing. The East is paying a massive premium. The Mint stopped selling. And suddenly, the casino offers you a cheap paper ticket to play the silver market without ever touching a bar of metal. They are trying to divert your demand. They want you betting on the price action, not holding the collateral. They are selling tickets to a lifeboat that doesn't exist. Why? Because the system is cornered. And when the house is cornered, they don't just change the odds. They change the rules of the game. And if you want proof that the rules are being rigged against you in real time, you need to see what just happened in the Japanese bond market. Because it's about to trigger a nuclear reaction here in the US. Let's cut through the noise. What we are witnessing right now isn't just a bull market. It is a hostage negotiation between the paper markets and reality. For decades, the price of silver hasn't been determined by how many ounces come out of the ground. It's been determined by how many paper contracts are traded in Chicago and London. They call this price discovery. But when you look at the new rules coming out of the CME Group this week, you realize the discovery is over. The cover-up has begun. We need to talk about variable margins. I know margin requirements sounds boring. It sounds like something only accountants care about. But in this specific moment, it is the weapon they are using to kill the rally. Here's the old way it worked. You want to buy a silver contract? You put down a fixed deposit. But the CME just changed the physics of the casino. They are shifting from a fixed dollar amount to a percentage-based margin. Why does this matter? Imagine you're playing poker. You have a winning hand. You're betting big. But suddenly, the house manager walks up to the table and says, "Hey, because you're winning so much, every chip you put in the pot now costs you double. As the price of silver rises, the cost to stay in the trade now rises with it. It acts like a gravity well. The higher the price flies, the heavier the boots become for the traders trying to ride it up. They tell you this is to reduce risk and ensure stability. The reality is, this is a speed bump designed to force leveraged longs to sell. They are trying to bleed the momentum out of the market by making it too expensive to hold a winning ticket. But the margin hike is just the defensive line. The offensive play is this new 100-ounce futures contract we mentioned in the intro. You have to ask yourself, why now? Why, in the middle of the most aggressive silver breakout in history, is the world's largest derivatives exchange suddenly worried about the little guy? Listen to their press release. Silver is increasingly appealing to retail traders. 100-ounce futures will improve access, enabling them to benefit from the liquidity. Translation: we need your money, but we don't have the metal. Here's the mechanism. When you buy a physical coin, a silver eagle, a maple leaf, you are removing supply from the market. You take it home, it sits in your safe. That metal is gone. It cannot be rehypothecated. It cannot be sold to anyone else. It is off the board. But when you buy a 100-ounce futures contract, you aren't buying metal. You're buying a price exposure. This new contract is a sponge. It is designed to soak up the flood of retail capital that is panicking out of the dollar. They know millions of people are waking up to inflation. They know you want silver. If 100,000 retail investors buy 100 ounces of physical silver each, that is 10 million ounces drained from the vaults. That breaks the COMEX. That creates a default. But if they can convince those same 100,000 investors to buy a micro-future contract instead, 0 ounces leave the vault. The price pressure is absorbed into the paper casino. You get a digital receipt that says you own silver, and the bullion banks get to keep the real metal for themselves. It is the oldest trick in the book. When you are running out of product, start selling rain checks. However, there's a flaw in their plan, a fatal flaw. They are assuming that the margin hikes and these new paper contracts will scare people off or distract them, but they are underestimating the psychology of this market. We are not in 2011 anymore. The people buying silver today aren't just looking for a 10% gain. They are looking for insurance against a collapsing system. Ironically, the margin hike I just told you about, the one designed to crush the price, it might actually accidentally trigger the mother of all short squeezes. Think about it. The margin rules apply to everyone, not just the longs, the buyers, but the shorts, the banks betting against silver. If silver spikes $5 in a single day because of a geopolitical event, which we will discuss in a minute, those short sellers are now on the hook for massive variable margin calls. The higher the price goes, the more cash the shorts have to post immediately. If they run out of cash, they are forced to cover. That means they have to buy silver to close their position. Buying begets buying. The price rises, margin calls go out. Shorts are forced to buy. The price rises more. They built this variable margin system to trap you. But if the physical demand from the East keeps pushing the price up, they may have just built their own coffin. And that brings us to the elephant in the room, the reason why their paper games might stop working entirely. Because while Chicago is playing with paper, Shanghai is draining the vault. Now, forget the CME for a second. Forget the margin rules. Forget the charts you see on CNBC. The most dangerous chart in the world right now isn't on a Bloomberg terminal. It's the spread between East and West. We are witnessing a phenomenon that monetary historians call decoupling. Usually the price of silver is roughly the same everywhere. A little variation for shipping, sure, but basically global, not anymore. While we in the West are staring at 89 silver and debating if it's an overbought, the Chinese market is happily paying nearly $100 an ounce. Earlier today on the Shanghai Gold Exchange, SGE, the price topped 22,400 yuan per kilo. When you strip out the currency conversion and the tax differences, you are left with a raw premium of over $10 an ounce. Do you understand what that means? It means the spot price you see on your phone is a lie. It is a ghost price. If you have a 1,000-ounce bar of silver in a vault in London, why on earth would you sell it on the COMEX for $89,000 when you can put it on a plane to Shanghai and sell it for $100,000? You wouldn't, and neither would the smart money. This is basic fluid dynamics. Money flows to where it is treated best. Physical metal flows to where the price is highest. This $10 arbitrage gap is acting like a massive vacuum cleaner. It is sucking the physical liquidity out of the Western banking system. We saw this in 2022 and 2023 with gold, moving from west to east. Now, it is happening to silver, but at a speed we have never seen before. The bullion banks in London and New York are bleeding inventory. They are frantically trying to cover their paper shorts, but the actual metal, the collateral they need to back those trades, is flying across the Pacific. This is why the U.S. Mint had to pause sales. This is why premiums on Eagles are about to explode again. The metal simply isn't there at the official price. We are moving toward a bifurcated market, the paper market, where you trade digital contracts for a fake low price, but you can never actually get delivery. The physical market, where the real price is $20, $30, or $50 higher, but you actually hold the asset. The CME is desperately trying to keep you in market number one. They want you trading the paper illusion. Because the moment you demand delivery, the game ends. This decoupling leads to only one outcome, a failure to deliver. Historically, when the spread between the paper price and the physical price gets this wide, The exchange breaks. We saw it with the London gold pool in the 1960s. We saw it in the nickel squeeze of 2022. The exchange will declare force majeure. They will force you to settle in cash. They will say, sorry, we don't have the silver, but here's a check for $89 per ounce. Meanwhile, the real street price will be $150. You will be made whole in a currency that is rapidly losing value, while the asset you tried to buy becomes unobtainable. And speaking of a currency losing value, we have to talk about why the East is buying so aggressively. Why is China hoarding silver and gold at record prices? They aren't just trading, they are preparing, because they see what is happening in the Japanese bond market. They know that the US Treasury market is one bad day away from a total meltdown, and that day might be today. Now, I need you to focus. Because if you want to know when silver hits triple digits, you don't look at the comics. You don't look at the miners. You look at Tokyo. Something is breaking in Japan right now that is going to force the Federal Reserve to its knees. For 20 years, Japanese bond yields were basically zero. It was a flat line. The Bank of Japan owned the market. But look at this candle from this week. The Japanese 10-year yield just smashed through 2.1%. The 30-year is pushing 3.5%. These numbers sound small to Americans, but for the Japanese financial system, this is a heart attack. Japan is the most indebted nation on earth relative to its size. They cannot afford high interest rates. If yields keep rising, their government becomes insolvent. So, they have a choice. Option A, let their own economy collapse. Option B, sell their assets to save themselves. Guess what their biggest asset is? Japan is the largest foreign holder of U.S. government debt. They own roughly $1.2 trillion worth of U.S. treasuries. For decades, they have been a reliable buyer. They helped fund our deficit. They kept our interest rates low, but now they need that money back. If the Bank of Japan has to intervene to save their own bond market or defend the yen, they will have to hit the sell button on these treasuries. They won't sell all of it. But even if they sell 10%, that is $120 billion of U.S. debt flooding the market in a matter of weeks. Who's going to buy it? China? No, they are selling too. Saudi Arabia? No, they are buying gold. The American public? We are broke. If Japan dumps treasuries, the price of U.S. bonds crashes. And when bond prices crash, U.S. interest rates skyrocket. And this is where the trap snaps shut on the United States. We are already paying $1.2 trillion a year just in interest on our national debt. That is more than we spend on the entire military. That is more than Medicare. We cannot survive higher rates. If U.S. yields spike because Japan is selling, the U.S. government goes into a death spiral. So, what happens? The Federal Reserve cannot allow rates to rise. They literally cannot afford it. So when Japan sells, the Fed will have to buy. They will have to restart the money printer. Not because they want to stimulate the economy, not because they want to lower unemployment, but because they have to monetize the debt to prevent a sovereign default. This is the pivot everyone has been waiting for. But it is not going to be a polite press conference where Jerome Powell announces a rate cut. It's going to be a panic response. They will call it yield curve control or balance sheet stabilization. They will use boring words to hide the terrifying truth. Quantitative easing is back. And the moment the market realizes the Fed is printing trillions to buy Japan's bags, the dollar creates a bottomless pit. And silver becomes the only exit door that isn't burning. But there is one final piece to this puzzle. A geopolitical wildcard that could take this financial crisis and turn it into an energy crisis overnight. Financial crisis, currency debasement, physical shortages. Any one of these is enough to send silver to record highs. We have all three happening at once. But we haven't even talked about the match that lights the fuse. Yesterday, oil prices broke out. Why? Because the geopolitical risk premium is finally being priced in. We saw the tweet from President Trump regarding Iran. Help is on the way. When you combine that rhetoric with the fragile situation in the Strait of Hormuz, you are looking at a potential energy shock that could rival the 1970s. Why does this matter for silver? Look at history. The last time silver went parabolic, 1980, it wasn't just inflation. It was an energy crisis. It was war. Silver is not just a monetary metal, it is a strategic asset. It is used in the missiles, the satellites, and the solar panels that governments need during a conflict. If oil spikes to $150 because of a conflict in Iran, the cost to mine silver doubles, the cost to transport it doubles, and the panic demand from hedge funds trying to hedge against inflation goes vertical. The silver to oil ratio is currently flashing a warning signal we haven't seen in years. The energy market is tightening, the silver market is breaking, and the paper market is trying to pretend everything is fine. So what do? The US Mint has already locked the doors on their numismatics. The CME is trying to trap you in paper contracts. The premiums are rising. The window of opportunity isn't closing. It is effectively jammed halfway shut. If you're waiting for a dip to $22, you are fighting the last war. If you are waiting for the Fed to save the economy, you are betting on the arsonist to put out the fire. The smart money isn't waiting. They are moving. Get physical. If you can't hold it, you don't own it. The spread between Shanghai and New York proves that paper promises are losing value by the day. Ignore the spot price. The spot price is a distraction. Focus on availability. Can you actually get the metal? If the answer is yes, the price is secondary. Watch the yields. Keep your eyes on the Japanese 10-year bond. That is your countdown clock. When that breaks, the dollar breaks. We are entering a period of history where the rules of wealth are being rewritten. For 40 years, wealth was financial. It was stocks, bonds, and digital digits on a screen. For the next 40 years, wealth will be tangible. It will be things you can touch, things you can hold, and things that cannot be printed by a central bank. The US Mint email was a warning shot. Next time, they won't send an email. The website will just go dark. The buy button will simply disappear. And when that happens, you will either be holding the metal or you will be holding a worthless currency, wondering why you waited. If you want to navigate this transition without losing everything, you are in the right place. We don't just read the news here, we read the signal. If you appreciate this level of analysis, if you want to be part of the few who are prepared before the panic starts, then make sure you are subscribed. Hit the notification bell. The mainstream media will tell you everything is fine until the moment it isn't. We will tell you the truth. Stay safe, keep stacking, and I will see you on the next one.